Hello everyone and welcome back to the channel. Thanks for joining me. And first of all, let me start by wishing you all a happy new year. 2022 is going to be a very interesting year from an investment perspective. So let's see what happens. And particularly warm welcome and thank you to those of you that have recently subscribed. There's been quite a few of you, and thank you to my regular viewers for joining me again in this new year. So the objective for this video is to find out where I landed at the end of 2021, so where I'm at for the start of this year for the £1 million investment challenge. For those of you that are the new subscribers, this is a long-term challenge that I have. I'm trying to kind of get rich slowly, if you will, take perhaps a less risky, more steady, methodical approach to hitting that £1 million investment portfolio. At 20 grand at the start of 2020, and yeah, let's see where that takes us. What I'll also share with you today is my three portfolios: the UK portfolio, the American portfolio, and the Asia Pacific portfolio, and I'll show you each of the holdings and the individual performance as of the start of the year, so we can see where the portfolio's at. I will do a separate video coming up on my sort of 2022 plans, but for now this is just all about the £1 million challenge, where I'm at, and performance of the portfolio. So as I said, the goal is £1 million, and if I go on that kind of base level, which is just 6.66% a year, I'll get there at 2060. I'm looking to kind of get there at 2050, which would be a 10% a year return. That's with £300 a month going into the portfolio. And a quick shout out, if you do sign up to become a Patreon VIP supporter, you can get a shout out in some of my videos. So thank you very much for the support there. The end of your target, the base rate of return, I should be around about £30,000 at the end of this, say this year, last year, end of 2021, start of 2022. And with the stretch target, that should be around 31,800. And where I've landed is a pretty nice number of 41,300. Part of that is investment return, but also managed to save a lot more money than I expected because of the various lockdowns, so spending less money, saving money on fuel, etc. So I've been putting over and above £300 a month, as the regular viewers will know. Now, compared to the last review, probably about 6 weeks ago, I'm down about 1,700 quid, but still way ahead. And we know that a lot of the kind of growth stocks have had a challenging month or two, which is why that's dropped. Overall, I'm very happy with that number, 41,304. It's a good position. I'm ahead of the run rate. And I think for me, what I'm realising with the investment, it's not a compulsive recession to beat the market. Now, beating the market is good, and it's a good aim to have. And actually, the key thing is one, or are you hitting your own personal investment objectives? Are you achieving what you want to achieve, that you set out, that will improve the quality of life, give you good balance? But to be happy and satisfied with what you're doing, you need to be making sure you meet your objectives, and this is my objective here, so pleased with that. And if we just have a look at that in sort of graph form, we've got the bottom red line here. That is the base rate of return, the 6.66. If I was trundling along with that in terms of the plan, that is where I'd need to be. The orange line is the 10% a year target line. So now where the black line is kind of the year-end value, that's where I'm at. So I'm ahead of those lines, and that kind of dotted red line is the base return rate readjusted from where I'm at now. So from today, I got 6.66. That's the trajectory that it would take. So it's good to have a look at that every now and again, just to see, in graphical format, what I'm up to. So that brings us to the key question: how many years to get to $1 million? And it's 27 more years, which is fine. This is not a get-rich-quick scheme. I don't know that I have the ability to do that quickly. Now, some people do, whether by immense skill or being able to put more money in, or by luck. I prefer the slow and steady approach. So here is the overview of my portfolio, and it's broadly similar to the last review here, with almost half the money in the American side. We've got 38% UK, 14% that Asia Pacific, and then only 2% cash. So that's gone down, but actually have since the start of this year sold out of one position. That cash pile has actually doubled. And the other sort of notable changes, I've got zero in commodities now, so I sold my oil ETF as well towards the back end of last year, which the regular viewers would have picked up on. So 41,304, that's how it's spread. So let's have a look at the holdings for those three main portfolios to see what's going on. So we're going to start off with the UK first of all, which is my more sort of established portfolio. So Boohoo's the largest position, and again, no surprise, done several videos on Boohoo, and I'll leave a link to the most recent one at the end. Now this is around about a third down, and it's still the largest position. I'm absolutely convinced that this is undervalued and has a low chance of failure, and there's plenty of upsides. I'm very happy to have it as my largest position. I think the position size is maxed out because it is getting towards something like 9 to 10% on cost of the portfolio, and from a risk management perspective, that is quite enough. Down 35% there. It is what it is. I'm not too worried about it. You do get, if you hold plenty of stocks, large ups and downs in them, and the key thing is patience and ensuring that you've made a good decision. So I'm happy that I hold this company. I'm happy that it's undervalued, low chance of failure. So let's see what happens. So actually the next largest position is a FTSE 100 index tracker, and that's 28% up. So that is steady as you go. The best performer in the portfolio is a fund that I've held since around about 2014. And it's getting on for 200% now, so it's a very nice kind of 15% a year or so compounder. Now, Aviva is one of my favourite companies. That's up 41%. It pays a very nice dividend. I like what the management's doing, simplifying, cutting costs, and it's a long-term business with a very nice dividend. And we get to around about halfway in terms of the money, and we're onto another fund here that's returned over 100%. And again, this is a hold for about 7 years or so, so that's compounded nicely. So it's quite a nice concentration in this portfolio. You can see the top sort of 5 positions there is over 50% of the money. Now we get on to the next level of holding. So FTSE 250, that's returned 50%. Again, for me, that's just a long-term compounder. And then we've got the K3 Capital Group, one of my favourite kind of small cap holdings, up 65%. There's a lot more to come from that one. Unilever 87%. That's a long-term compounder. I get a 5% dividend on cost on that one. Then Shell up 18%. So I'm thinking about Shell because although I don't want to go super concentrated, like 5 or 10 holdings, let's say, I do want to overall sort of trim out a few positions, and I work out my plan for what I might sell this year. Shell is potentially one of those. Fundamental base of the company is changing. They're moving slowly but surely away from some of the fossil fuels and into the kind of more renewable side. Changes their underlying business, and it's kind of a cyclical company to an extent at the moment. So as its oil price goes up, Shell will go up, and then I may consider relieving myself of that one. It's another 100% club. Performed really well. Investec 168%. That will hit the 200%. I'm absolutely sure of it. It's very much undervalued. It also pays out quite a nice dividend as well. So that's been a good performer. Yeah, Legal & General, similar to Aviva, solid company, unlikely to fail, good dividend, 47%, and also 47% on BT as well. City London Investment Group, another dividend play, up 34% in a year and a half. That pays out a nice dividend. Direct Line 23, that should be in green actually, so I was saying that's plus 23. British American Tobacco is basically level, 1% up. That pays out a nice dividend. Duke Royalty 77%. Alternative financing company, I think they've quite a nice long-term compound potential. Plus 500 just down a touch, down 6%. Another mutual fund up 51%, and then Argo Blockchain down 21%. So overall, there's lots of green in this UK portfolio. Boohoo's the only really significant portion of red. Other than that, there's a huge amount of green there, and there's 3 dark greens at 100%. So I'm happy with this portfolio. There's more of a dividend focus on this one. You've got people like City London Investment Group, Legal & General, Aviva, Direct Line, British American Tobacco. They'll just chip in dividends and just compound away nicely over time. Pleased with the portfolio. Otherwise, it's quite a stable portfolio. I can't see anything super undervalued to add to it. Just as a bit of a shout out, if you're getting value from this, you want to support the channel, I'd really appreciate it. And there is a Patreon site there for me. If you are a VIP supporter, as we mentioned, you get a shout out in the videos. Go and check it out, and appreciate any support from you. Right, Asia Pacific next up. And again, probably no surprise to the regular viewers that Alibaba is the largest holding, down 29%. I do think this is undervalued, and again, patience is required here. It could take 1 year, it could take 2 years, it could take 4 years, but I'm convinced I'll make a good amount of money on this. Another mutual fund long-term compounder here that's been doing kind of 8% a year, so that's plus 86%. An index tracker here, so Pacific area excluding Japan, that's up 7%. I've only had that probably about a year and a half. China index is down 16. I've got quite a lot of exposure to China, so I won't be adding any more to that going forward. Huya is probably about the worst performing position I've got, down 45%. Now that really has dropped off dramatically. it does look very undervalued, and I think it will recover. It might take some time. Other side of the coin, we've got Kelly Partners Group in Australia up 44%, so that's sort of taken off again in the last few weeks. And a couple of smaller positions, Australia Fund 17%, and Baidu at minus 25. I'll probably exit out that Baidu position with that one. It's too small to make any material impact to the portfolio. I'd rather have the cash, and there are other companies I'm more convinced about that are cheap, so that's what I'll be looking to get rid of. So what do you reckon about that one? Comment below. Am I a bit of a nutter for having so much in Alibaba? What do you think? So I know there's a few different views out there on that. So American portfolio, let's go. Banco's okay, but up 88%, and even since I took the kind of extracts at the end of the year, I think it's about to hit $50 a share. So that'll be pushing 100% any day now. For me, this is just a hold. No point in trying to sell this one. It's a nice long-term compounder, great management team. So, and interest rates, if they start going up, it's going to get even better. Corsair down 25. Arguably when I entered, it was at a fair price rather than a cheap price with a margin of safety. So that's perhaps a little lesson for myself there. But happy with the business. Founder-led, been around 25 years or so. Good quality products. I know the company. I know the products. I've got no problems holding that one for a long period of time. And Micron's had a good couple of weeks, isn't it? It was getting towards $100 a share, up 27, and this is a nice hold for me. And it was a relatively new addition to the portfolio about 3 or 4 months ago. Uning Group, for me, a long-term compounder, not very exciting, undervalued, pays nice dividends. I think they're doing share buybacks. Just going to hold this, and this will hit 100% at some point. It might take 5 years, it might take 7 years, but it will get there, and happy to have it in the portfolio. Now, Walgreens, now since I took this extract, I think they've gone up a tiny bit more, and they've just done quite well in earnings that come out today. So again, I think the management team is excellent. They seem to consistently beat earnings. The dividend was 4% when I went in. I think it's 3.5% now because the price has gone up a touch. Definitely a long-term hold. And Tenant FinTech, yeah, down a third. It's very volatile stock, small cap, long-term hold again. Yeah, there might be an opportunity to average down here. Dropbox, I really like Dropbox. It was up about 40% at one point. It's dropped back down to almost level. And I did add to the position a touch, I think it was last month. And if it drops, keeps dropping again, if it gets down to sort of 20% down, I might average in again because I think management team's excellent. They consistently beat earnings. They are, in my view, undervalued. Strong business. Very happy to hold. And now we've got 2 very interesting ones, probably which I'll both sell towards the end of this year, if not slightly sooner. 2 coal companies, so Ramaco Resources and AMR. We've got 218% and 637% return on those. Now, the way that the metallurgical, not thermal, metallurgical coal pricing is going, it's looking like some of the numbers for this year, 2022, will be pretty spectacular. There could be some fat dividends as well. Although they look amazing, their return, I think there's actually more to come on these, so it could be fun. Keep an eye out for them. The GAN on red here, minus 29%. It's dropped a little bit more actually since the start of the year already. And this one I think is a company where they are growing very nicely and they have a low chance of failure. Again, I'm happy to hold and let things catch up with how well they're doing. US index, I've actually split this out into 2 positions now because it's actually held over 2 different funds, but this one's up 27%. Just again, long-term hold compounder. Now, TDCS one I'm interested in. It's down 22, and I think, again, today, as of recording, it's dropped even further, actually. I think it's down to like $13, so you're probably looking at down 30%, let's say, now. Management team haven't been that impressive in the last couple of earnings reports, and they have done some really good deals with a lot of good retailers, so there is growth scope. I'm not quite sure the management's doing the business here. And when I last looked, the chief operating officer also took on the CFO role as well. I'm not quite sure that's the best thing for them. I think they really need to demarcate that if they haven't done already and get some people in because they've got really good potential, but I'm not being impressed by what they've been doing the last couple of earnings calls. So I'm keeping an eye on this one. This might go this year if management doesn't improve its performance. Anthem has really improved recently, so up almost 50% there. Again, another long-term compounder is going to sit on that and see what happens. BP Midstream Partners. So actually, since the start of the year, I've already sold this one because BP are taking them over and they want to get BP shares in exchange. I don't want BP shares. I wanted the 10% dividend of BP Midstream Partners. So I've sold them, and the overall profit in the end was, I think, 46% in that year and a quarter. So I'll take that. But I would have liked to have had the 10% dividend for an infinite amount of years. But take that profit, but that's gone. So I've got a bit more cash, so that's why my cash pile, I think we said 2% earlier, it's now 4% of the portfolio. Cumulus, quite volatile, but this is a very good management team that's turning around the company. And they do often beat earnings. So I think this could be the year when they start to get recognised. US Bancorp, again, a long-term hold. I think Warren Buffett owns this one as well. So what's not to like about that? He knows more about them than I do. And if he's holding, I'm happy to hold. Same with American Express, 71%. Love the company. Long-term hold. We talk of Warren Buffett, Berkshire, that's gone up recently, so over 50% return there. And yeah, again, a long-term hold, no point selling that one, that would just do its thing, no chance of failure at all. The other US index fund, 29% on that. Now, Intel's down 15, and they have rallied a bit recently. And again, for me, long-term hold, and if this got down, again, for me, long-term hold, if this got down to sort of minus 25, minus 30%, I might well consider increasing that position, averaging in. Turtle Beach's disappointing. So it was up about 70% at one point, and they really have dropped off. And there's takeover talk at a price about 35, or perhaps a touch higher than that. And if that goes through, that's quite a big premium on the current position, but I still think that undervalues a company. But that's another one that probably will end up going there for this year. Seritage, very long-term hold on that one, bit of an asset play, 13% down. In mode, been quite volatile. It was up 200% basically at one point. It's now 137%. Still good performance. Still would have held that, and it should compound nicely over time. Voyager's down 3%. Again, a volatile stock that's very much tied to the price of the various coins. Happy with the way they're growing, and they've got a good management team there. And the last year holdings, you've got Stern Ruger. I think I've got a 5% on cost dividend there, which is up 2% overall. And Altasource, this is probably a riskier kind of cyclical play, down 7%. Something should start happening with that one this year. So those are the portfolios, the performance. Let me know if you like this format in terms of doing it all together. So the £1 million update and all the portfolio performance at once. Let me know your thoughts on that. Click on screen now to see that Boohoo video that I mentioned.